TGIF Warriors, good consumer pain index day. Jerry, how are you? See who's around. Richard. Hi, Ryan, Sinatra, David Hess.
Okay, that was funny. That was funny,
Bergman.
Dale. I'm sorry. That was funny. I just had to say consumer pain index. That's great.
Okay, good. I'm going to let Shahab. I got 1 million of them, Blake. You know that. So, all right. Let's stop the share here. I featured the Traders Funding Program because, besides it being great, the reports of new people qualifying every week is really amazing. Okay, so, it could be changing people's lives. And on a short-term basis, I want to tip my hat to Ryan. Yesterday when we were up here during ECB, and he, had a vibe that if we didn't get over 108s during the presser, to be careful that it could be vulnerable. So, great trader intuition on that, Ryan.
Thank you, mate. Thank you, mate.
Yeah.
I hope you help people.
Yeah. So here we are approaching, different fib levels here. I was, all along hoping I'd have a chance at, with a 105 handle. And here's the monthly off number. You just count back 2 candles. We had a reversal month last month, but the off number this month happens to be 105.45. Okay, that means, by the end of the month, it has to hold that or close above it. And, that's at this line and in between 50 and 61.8. Any interest in buying that, or do you just stay with the strength? I think this is maybe important. Maybe this is all we're going to get on the downside, and Aussie acting the best. Comments?
Yeah, it's acting the best, but that's like saying it's the least crappy one out the pile.
Okay.
The cleanest dirty shirt in the pile, let's call it that.
Yeah, okay. So are you kind of in the camp that this move in the dollar index, that it's going to take out the high here? Make no highs in the dollar?
I think we could take a look up there. I think what we've seen from all the central bank action we've had, the Fed is still leaps and bounds ahead of everyone else. And when you look at it purely on that basis, we've had the ECB now confirming the hike process, even towards the hawkish side, and the Euro's near on 200 pips lower. The same with the RBA, entering a hike cycle, surprised the market to the upside with a 50 pip hike, and we're down. When the market is judging what's happening with all the central banks, it's saying that the Fed is going to keep ploughing on. Other central banks are already, countries are facing potential economic weakness, and the Fed is still trucking along nicely. Where are you going to put your money if you're an investor?
Yeah. Where is the question? Do you think that the S&Ps yesterday taking out this little triangle everyone was looking at, again, when you think about it, and this was not my idea, all one market. It's all one market. Every market has been financialized. Look at the similarity in patterns everywhere. You had a bounce, and now we're getting a test of whether all these bounces were real. But you see how they're, it's like a balloon. When there's oxygen coming in, everything rallies, and then when there's, it's being sucked out of the balloon, everything declines. It's like the whole market is financialized, and I don't see any differentiation across different asset classes. It's all about either everything's good or nothing is. Does it seem that way to you guys?
I think you're absolutely right, Dale. I think the market has got 2 things going on, particularly in stocks. One is the global economy going to get crunched from all these hikes? That's the first thing. Second thing is, particularly for stocks, we're at the end of the easing policy. What does that mean now? That means the punch bowl is going. Stocks are going to have to stand up on their own 2 feet. So what we're going to have is a period of reevaluation. What do stock prices mean? What do PE levels mean? Are we going to switch back to stocks reflecting the fundamentals of an economy? We haven't seen that for 15, 17 years.
That's true.
Since before the GFC. There's people in this market. If you're 25, 30 years old, you don't know what it means for stocks to follow an economy. You know what stock means to follow QE.
Brian, I want to say that it's almost true. You talk about this as interesting. I was having this conversation with my wife last night. We were talking about just if you look at like millennials, which make up a lot of the consumer right now, the younger consumer, the first time home buyers. They haven't really, they haven't experienced a lot. It's interesting because the younger generation, whatever the kids are right now that are teenagers to teenagers to early ages, they've kind of experienced
30s.
I would say 30s towards millennials. They've experienced like some heartache, COVID, and everything else. And I know the millennials have too, but they were really in that younger 20s, college age, really not paying attention to what's going on. But now you got these generations that are now getting into these, whether it's the markets that we're dealing with or just in life in general, they have less experience and less heartache, or dealt with less heartache in the world. So it's interesting. And when you take like the traders too, the traders are really have just not seen anything like what we're seeing now. So anyway, I just
used to trading what we deal with now, and if things flip back to how they were 10, 15 years ago, that's a big adjustment for traders to take. Then you got people like Dale. He's he lived through the 1920s. He's seen it all.
Yeah, I think being there for different cycles is helpful.
Yeah.
So anyway, I liked it back then. The only problem was my ticker tape. That glass kept fogging up. I couldn't really read it that clearly, But what are the expectations for CPI? The number? What's everyone looking for today? This could be a big market event.
Yeah, core a bit softer, expecting it at 5.9 versus 6.2% prior.
Okay.
The headline CPI coming in unchanged on last month, year on year, 8.3%.
Okay. I almost would like it not to be, everyone's hoping for this, a little bit of a softening, but I'd like the bonds to like get this over with and flush. And I think that'll be like the final acid test for how far is the dollar going? How deep are the metals pulling back? And, I don't think you can rule out in the S&Ps that, this could have been an A, and we pull back and do a fib extension, then get another one of these. Just because we broke this, it hasn't completely invalidated the whole rally from that 3,800 level, has it? Yet? Blake, what do you think?
I'm sorry, Dale. I was actually just reading something as you were speaking, right. So I was not completely paying attention.
That's bad. All right. No.
But you know what?
I bet can't this just be a correction? Even though
as far as the S&P goes? Yeah, I think so. I mean, we're at a 50% retracement. I think that, the market reaction, like a lot of people look at the let's just call it the dollar reaction yesterday, the sell-off in the euro, following the ECB. I think a lot of people pointed fingers at the ECB, but I don't necessarily believe it was all ECB. I think the dollar caught a safe haven bid literally across the board. I mean, if you looked at like the dollar yen was ripping as stocks were moving higher or lower, excuse me. And so that move lower in the S&P just tells you that like, and it suggested to me too, when we broke 40.75, which was, kind of like it was like almost like a double bottom, or, it forged out as support actually 3 different times this week. When that cracked, it's like the dollar just kind of accelerated against everything. And so, I think it was like one of those domino effects yesterday. We saw, you know, stocks down, they continue to go down, the dollar continued to stay strong. And so now here we are, and we're at the 50% retracement. It's also, if you look at just, you know, move your cursor to the left to 2 weeks ago, you know, we are basically at the highs from, you know, May 23rd. Yeah, right there. We're basically at the breakout point from when, you know, everybody was shorting the stock market. S&P's below 4K, thinking we're going to 3,500. They got squeezed 2 weeks ago. I made this point in the ForexAnalytix chat room yesterday. I'm like, let's not forget, we're just where we were at 2 weeks ago when we were squeezing past 4K, squeezing out all the shorts because everybody was super bearish, right? So here we are just at this very pivotal level. And I think today's event's going to be very binary. You know, you have strong data and everybody's anticipating it. Every bank expects hot data. Everybody's bracing for it. Right. The consumer pain indexes, Dale, as you said earlier. Everybody's bracing for a hot data today. And if it's hot, you know, we could get a couple of different things. First of all, I think that the S&P could, you know, continue to break lower below 4K, but also you might get a buy the rumor, sell the news, because everybody's leaning into a hot print today. And because of that, also most economists believe that we're at peak inflation right now. So that one last hot print might be like, yeah, that was good, but June's going to be light, so everybody, sells into a strong number. And then we get a reversal later in the day. I think that is a risk as long as it's not super duper hot. Now, if it's a weak data, everybody's going to be caught wrong footed. Everybody. I believe that the S&P will be back at 4,100 by the end of the day. If anything comes in a little light, you're going to see the dollar retrace most of this. You'll see the euro back at because the ECB didn't. I want to get some comments from K-Man and Ryan and Stelios. Stelios isn't here. I think he's at.
I'm here.
You are here. Oh, good to see you, Stel. Okay, so I'd love to get you guys' opinions about the ECB yesterday, because I don't think they really surprised anybody, but that's just me. I think they just moved the goalposts, not shifted the goalposts. They just kind of moved them around a little bit. Anyway. I think the euro could be trading right back at 107, by the end of the day if we have some weak data. But let's ask what the team thinks about the ECB, since you guys got to hear, Christine Lagarde, and you got to hear what she had to say. What do you guys think here? Ryan, you probably talked about this ad nauseum with.
Put someone else, and I'm done with the ECB.
Okay. I want to hear your opinions. Stelios has all sorts of opinions.
Of course I do. About Ryan. No,
I've got my opinions too. I got opinions
for me, the ECB yesterday.
In a room.
The ECB yesterday shifted the goalpost a little bit, like you said. What the market didn't like was the fact that they effectively ruled out the 50 for next month, which I thought was unneeded, but they want to go as slow as possible, and that's what the market didn't like, and that's why the euro is struggling. Now, that doesn't mean that they can't compensate for that by doing more later, but it just shows you
the 7.5 BPS possibly that, right.
But it just shows you the rationale that the ECB has. It's like always slow, always pre-announce it with various stages and blah blah. It's like they're the slow-moving train, not train. What you call it? Really, like a big ship.
Train wreck.
Yeah, exactly.
How do you feel like being in the train wreck right now, Stelios?
Great.
Squarely.
Yeah, I kind of disagree though, Stelio. You notice how they're very slow, and that doesn't only apply to the ECB when it has to do with tightening monetary policy.
Yeah.
But when there is a quote-unquote emergency that actually requires loosening monetary policy, everything happens between meetings as fast as possible. Quantitative easing is planned and executed within a few days, so on and so forth. So that is actually the problem. The problem is not that they're cautious. The problem is that they have a very, very specific bias, because their monetary policy is not independent as it should be, but totally dependent to the fiscal situation that is, the reality we live in for many, many years globally, right? So that's the big problem. They wouldn't be hesitant at all if the situation was completely different. If, let's say, inflation was at 0.5%, which they try to persuade people that would be a problem, right? It isn't, of course, but they try to persuade people that that's the case. They wouldn't plan rate cuts. They wouldn't plan slowly quantitative easing. They would announce it and do it within a single meeting.
Right.
You know what's bonkers, Steve? Go and look at ECB's Kazakh's comment just before. He says slow. He says gradual isn't slow.
Okay, a distinction. Isn't that what you British people would call a distinction without a difference?
No, I'll call it bullshit. That's what.
Yeah. Okay.
I'd like to know.
You see, I wanted to be politically correct.
Hey, so,
for one time in my life.
Your long-term bullish euro. Aren't we entering some buy zones for you?
Who's that to, mate?
That was Stelios.
Yeah.
Okay.
But I'm not going to be doing anything before the CPI, obviously.
Okay, and you're really waiting on the Fed to take a lot of market action, aren't you?
Yes. Yes, I think that's going to be.
And so far, it's been, right to sit on your hands to be able to, if your narrative is right, to get great levels to be in. So
yeah, hopefully. I do agree 100% with what Blake said. If today, logic says that CPI today should be hot, but if it isn't, everybody's going to be caught offside. Everybody on the wrong side.
Speaking of what that's Dale, one comment on what Blake said before. You remember it was roughly this time of the year last year when we had, I think, the single incident last year that inflation came in lower than expectations. I think if I'm not mistaken, it happened only a single month last year, and it was around spring. Everybody, the economists, as Blake said, started calling that the peak of inflation, and we all know how well that worked.
But Steve, look, I understand exactly what you're saying. That has nothing to do with the outcome of today. The outcome of today will move the markets. What happens a month from now or 2 months from now?
A different story.
I don't believe that inflation is peaked, but today the market will move on it.
And I do agree with you. I do believe that if for some reason we see a slowdown in numbers, everybody's going to be calling the top of inflation. But my point is, I very much doubt that we're there.
Of course. But what can happen in the meantime, while you're pondering that idea, is we could go to 4,300 and then reverse, right?
Absolutely.
So so that's why today is so important. So we have 13 minutes before the data comes out. We haven't heard from K-Man. What do you think, K-Man, as far as the data goes? What are you thinking here?
Good morning, afternoon, everybody. I think I'm of the complete opposite opinion. Everybody hopes for a lower one.
Oh, of course, everybody hopes.
Go in any chat room, go on anything. Everybody's long stocks to their eyeballs. Everybody is buying the dips in the euro. Everybody is trying to sell dollars. I'm completely the opposite opinion since since yesterday. Yesterday until yesterday ECB. I was wondering what was going to happen. Can we break 108? Can we do this? Can we do that? Actually, the market was hoping for a little bit more hawkish ECB, and we didn't get it. And look at the market reaction. We're 200 points lower from the highs in the euro dollar. By the way, we're sitting on the 50% here of the rebound in the euro dollar.
Yeah, right here at the 4,000 level. This is kind of
interesting, as we are on the 50% of the S&P as well, if I'm not mistaken. So I think the market is actually hoping for a softer one because it's going to be easier to trade. If
it will be.
Comes out. It's Armageddon this afternoon, in my opinion. Euro trades 104, cable trades down to 123. And I don't know. Sterling looking an absolute piece of crap for the time being. We could not get above the 126 earlier this week, where the occasion were there to do it. We're trading 124.5. Yeah, it's going to be partially binary, in my opinion. A high or a low one, this inflation. But personally, I'm a rally seller of I'm a rally seller of weaker currencies rallying against the dollar this afternoon, i.e., I would be a rally seller on the cable. I would probably be a rally seller on the euro dollar. Dollar yen, I'm leaving it alone with all those Bank of Japan warnings and next week Bank of Japan meeting. I will buy a cheap downside if I can get it. If dollar yen would trade above 135 before the BOJ. Because after those meetings, I reckon they might say something about just discussing some normalization. But yeah, I'm a bit of the totally opposite opinion. If I get a rally in S&P 4100 or 4150, I think there might already be people being very happy to see those levels again.
All right. Well, you're in the camp basically, as Steve says. If we get a soft print, you're going to look for a rally to sell in the euro, the sterling, et cetera, et cetera. Now, you and I, K-Man, we trade a lot of emerging market currencies, and I actually sold some Euro-MEX yesterday. Here we are at the lows here. This is one of those currencies that you guys know for the last several years. It was one of those currencies that actually gets just mauled from a carry trade standpoint as stocks go higher. So when stocks go higher, you sell dollar or Euro-MEX, you can sell dollar-MEX too. It's probably one of the best carry trades of the last several years. And here we are right now at the lows. Do you read into anything that's happening with emerging market currencies at this point? Because I know you professionally have traded, emerging market currencies on trade desks at banks over the last 40 years. But how do you feel about them right now?
I'm with you, Blake. I'm a bit short Euro-MEX again since yesterday.
Yeah.
And I prefer to do the Euro-MEX than the dollar side because of carry one end, but then the dollar I'm not very bearish dollars. I've been trying to sell dollar-MEX and dollar rand, but they both tend to rebound from important levels. So I prefer to do the Euro-MEX. I think if nothing else, let's say if there's no catastrophe in the market, this Euro-MEX still looks vulnerable. Well, the same could be said about sterling-MEX or other things, but the Euro-MEX could still be vulnerable. I wouldn't be surprised if we find this thing back at 20, the big figure test sooner or later. The 2020 low.
Yeah,
I would really not be surprised. And if I may just 10 seconds, because we have Canadian labor report out as well.
We do, yeah.
There's a big level on the Euro Canada, 133.90 figure. If that goes, if the Canadian labor report surprises on the good side, you can see the triple low there. If that would ever go, there's not a lot to hold this one back to trade down to 130 actually.
Good.
I'm really watching that level very closely. I don't have a position, but it looks to me still to be the weak side.
And you know what? With crude oil trading at 123 today, I mean, well, near 123. I mean, crude looks like it's just going to continue to plow higher towards 130. And as crude goes up, it's gonna be a tailwind for the Canadian dollar. So that's a good look. So I want to go around the horn really quick. We have 7 minutes or 6 minutes until we see the market move following the CPI. We'll also have Canadian employment data. Steve, what's your best idea today? What do you think? What would you like to trade today if you're looking at anything? Steve. Steve.
Ricketts.
We may have lost Steve. All right, Stelios.
I'm just messing with you. I'm here.
Oh man, that's not cool. All right, so what's the best trade idea? What do you think?
You got me as I was changing batteries to my headset.
Oh, okay.
Yeah, sorry.
All right.
Sure,
Well, let's get you after Stelios. So, Stel, what do you got?
What
are you thinking? Give me some actionable. Buy silver. Come on, buy gold.
He's waiting for the Fed.
For an intraday trade, I don't know, man. I really don't.
You're no help.
Sorry.
Holy cow! All right.
What I'm looking to do is sell into strength.
You're gonna do opposite of whatever Blake does. I get it. All right. Okay. So, Steve, what are you thinking?
It's not easy, but I need to respect the reaction we got yesterday, meaning the rejection in the Euro USD.
Okay.
And the breakdown from the recent consolidation that we had in equities. So especially in my opinion, if data are in the right direction for continuation of these moves, right? So if inflation comes indeed rather hot, I think we should be looking to see follow through.
Okay, and I'll just point everybody out here. The spike low of June 1st to the spike high from yesterday, 161% extension, comes right in to this little spike low here, which I bet you is about a 50% retracement of this entire move. So
618.
It's a 618, pretty damn close. It's actually in between, but interesting. Thanks, Steve. All right, Ryan, what are you thinking today? What's your best idea today?
Maybe a couple. Euro dollar into 105. I think that will mark a bit of a decent enough level for a stretch point on a big CPI number. Maybe dollar yen up towards those highs. We've had, it's developing a top there. We've had 3 looks. So that's developing. See whether we get a range building between there and the low 131s.
All right. Anything else? I want more free ideas. Give me more free. More free. Just kidding. I'm just pulling your leg. K-Man, what are you thinking? What's your best idea today?
Well, that's what I said. Any dollar, any cable rebound, I'm looking to fade 125 and above, ideally. And I'm going to shut up on the euro because I'm getting too bearish again. So I'm going not to mention it at all.
Okay. All right. That's fair enough. And it's kind of one of those things like when you're trading really well and you're like, yeah, I need to pare back on my sizing because I'm getting a little too cocky. If you're getting too bearish to euro, sometimes you got to kind of take a step back and reassess. Very good. Dale, what do you think? What's your best idea today?
Buy a break in gold down to like 20 to 10.
Wow. Okay. So
18 lower and a silver 21.10 to 20 be a buyer, and euro 105.45 be a buyer.
Okay. All right. Okay. So 105.30. What's that, K-Man?
What are you going to do, Blake?
I am continuing to buy emerging market currencies. So I got stopped out of the dollar rand yesterday for a loss, but I don't mind playing it on the long side again. I'm leaning into the Euro Mex and the dollar Mex as well. Dollar Mex has been flirting with 2020 or 2022 lows, and we're looking to I think give back everything that we got on the COVID lockdown. That's the COVID lockdown, by the way. I think we're going to trade back down towards 19. Continues to trade heavy. So I'm going to
Thanks for subscribing, Kareem.
Yeah. Hey, there you go. Kareem, we'll see you in the chat room. By the way, really quick, we got a minute and a half before you guys want to see how active our chat rooms are. This is just the general chat. And it's, Friday, and I got here an hour and change ago, and that's where I came in, right around here. That's just in the general chat room. You got the Flownomics chat room, which is pretty much the macro chat room. You got the trade room where we all put our trade ideas and what we're buying and selling. And you see, I even put my open positions. We have a Spanish chat room, news and research room. It's really probably one of the most robust trading communities, and that is part of ForexAnalytix. So it's only $1 for 10 days to try it out. If you do take the trader funding program, you actually get that community for a period of time while you're going through your assessment, because we don't want you to trade alone. We want you to trade with our community. So anyway, that's that. We have how much time? We have 40 seconds.
40 seconds.
40 seconds, says everybody. So here's data flash. This is actually included with ForexAnalytix. I'm going to move it out of the way for a second. Let me put up a couple of charts. So I'm going to put up the dollar yen first and foremost, and then I'm going to put up, you know what? I'm not going to do that. I'm going to do the S&P. The reason why I'm going to do the S&P is because we're going to be able to see how, wow, that's not right. There, is that right? 15-minute chart. Screw it. All right. You know what? We're going to go. We're going to be paying a very close attention to the dollar Canadian as well. So
okay, let's go.
Okay. Oh, data just came out.
8.6. Oh my God.
Holy Moses. That is a strong piece of data. Holy cow. No wonder the whole market was leaning into it, right?
Yeah, they knew yesterday, didn't they?
Wow.
Yep.
Wow. That
Core not as hot. It's above expectations, but still below last month, 6% versus 5.9%.
Yeah, but I mean, come on.
I know, like,
we're still
does
talking
that
about an
matter?
inflation rate of 8.6%.
Oh,
This
What are
is
the bonds
boy.
doing, Blake?
What's that?
They hitting the bonds and notes here on this number?
Let's take a look here. Oh my goodness, that
And
was
we have
good
year-end
employment data out
earnings.
of Canada, by the way.
I wasn't even paying attention to that inflation.
New highs.
Look at the yields are ripping here.
Isn't it funny how both the
No,
Eurozone
that's
and
not new
US
highs.
inflation is above 8% and one is going full tilt with hikes and the other one is like scratching its head? Isn't it funny?
Maybe you fade this.
Yeah, you can't fade it. You can't fade it.
Yeah, as I said before, Blake, I think the market wanted to continue on yesterday's rejections as long as we got strong data. Strong. I mean, strong is the wrong word. Bad data, because that's bad data actually. And I think now we have the green light to see, these moves that we got yesterday continue.
Yeah, I mean, that's exactly what's happening. You got the euro that's slipping towards that 105.30. And you guys were talking about, hey, maybe buying the euro down here, but it's hard to do that when the data is as strong as it was. Now, maybe we get a reversal. Maybe, 2-3 hours from now, we go, wow, the market was really leaning into it. So we get a reversal. But it is hard to fade it when the data is so outsized.
And another two moves that we shouldn't be fading, technically speaking, as well, Blake, especially with the combination of this data, is the breakdowns we're getting today. I was focusing on these charts the previous days on the morning edge. Gold and silver. Gold and silver were in corrective rebounds. And we're seeing them break down from the corrective channels they were trading within. So I think because it's the usual type of thinking that inflation is even stronger, so the response from central banks is going to be even stronger. So that means that real rates are going to move higher, in this case in lower negative territory, and they've explained what's the fallacy of that thinking before, meaning that normally speaking, these type of data that we're getting should be getting gold and silver bid. The reason the opposite is happening is because investors are still trusting that central banks are actually going to fix the problem, right? I think that trust is going to erode rather fast, but for the time being, we have to respect this type of thinking.
Where would you buy the metals, Steve?
Further losses.
Where would you buy them? In Peters in the wing?
Yeah,
we have Peter today.
We have Steve. Yeah. We have an interview. So just
perfect.
Be quick.
Yeah,
as we do every day after data. So just be quick, real quick. So what do you finish your thought?
I think short term lower.
Okay. All right.
Okay.
So all right. Let's and that's coming from a metals bull. Just everybody.
Oh yeah, my long term thesis remains very, very bullish. But short term, no.
Okay, so hey, I want to thank everybody for being here today. Dale has a great a gentleman to interview. Peter wasn't he? Didn't he? He was we missed him last week. Didn't he?
Peter, we missed you on Wednesday, was it?
Yeah, everyone was worried, and because my first reaction, Peter, is like raised by my mother. I'm
alive. It's okay, guys.
Oh my God! Oh my
Good,
God!
all right.
It's not like Peter.
That was my mistake. Sorry. I
was
got
calling the hospitals in Germany and everything, but thank God.
Peter, glad to have you here. Thanks for sharing your knowledge with our community. I'm going to pass you over to Dale.
Yeah, thanks, Blake. Thanks very much, Steve, and also hi to Dale.
Hello, Peter.
I'm sorry about that. I got lost in my chart. Sorry, and when I do that, sometimes there's a time warp, and I don't know where I am.
Yeah, but it's a good sign. People get worried because they wouldn't know, the wave structure of Bitcoin without you.
Oh, Bitcoin, yeah.
You think they care because they love you, but they just couldn't live without. They couldn't live without your work. So anyway,
well, that's a sort of love, isn't it? I mean,
it's love and greed and all of that good stuff. So
yeah,
share your screen, buddy. There's a lot going on, and great to have you on here. Someone also posted earlier. Okay, we could start there, but some guy, David Murrin, just did an interview on Palisades that we've been on, that there'll be a big washout in gold still. So
that's interesting.
Yeah, so we're getting I'm seeing more and more of that. Gold is not gonna.
Do you want to start with gold then, or what?
Yeah, let's start with the metals here.
Okay.
Although you know what, let's start where you wanted to start. So we broke down under, everyone was looking at that little 4100, that little rectangle that was in this week, and it broke down. You showed this can be a break to buy here. We're not going to take out 3800 right away.
No, I don't think so. I mean, I'm starting with this daily chart because for those guys tuning in today that aren't familiar with what we've looked at in our forecast before, one of the big things which I'm typing up our mid-year report at the moment, and so I'm sort of a bit focused on some larger perspectives as well. But
just for people who may not have been following your work, you put out a special report at the end of last year, calling the top, and then I had you on around A on the first decline, and I was saying, well, couldn't that just be it, and one ABC and we go to new highs, and you said, well, we could rally, but I think this would be a failing rally, which it was. And then down here at this 3800 level, for the last several weeks, you're looking for about 4460.
Yeah, I think the take-home message that I'd like to convey really is that, first of all, when we got to the pandemic low, the secular bull uptrend was still intact. This was an intermediate fourth wave correction. So we've got targets up to about just shy of 6,000 for the S&P. For later, yeah. But the biggest impact really is that the post-pandemic advance, we're used to thinking in Elliott wave terms of 5 waves as depicting trend. But there's an exception to that, and there's only one exception where a 5-wave pattern begins with a zigzag. And we've determined that this is a zigzag because, if you take a 61.8 extension, which is a normal ratio to depict a zigzag, if you extend wave A like this by 61.8, you're getting within the price parameters of that top in January. And this confirms the zigzag pattern. Now, the only pattern that you can really construct together as a zigzag when you've got an uptrend is the ending type diagonal, which looks like this. So here's the zigzag, and it becomes wave 1 of the ending diagonal. But by default, if we're looking at this contracting type diagonal, by default, you're going to have a deep correction downwards, and that's what we said in December's annual report.
Yeah,
we said, well, look, we
raised it a little bit, didn't you? Wasn't it more like 26 or 2,500 for a final?
2640 is the 76% retracement. Normally, I default to that because you see it so often. It depends on the amount of time consumed. What's important about the downside target is that it can be either 61.8 or 76% generally, but you've got to get the angles, your angles correct. If you get a sharp, much steeper drop than this, what we've had so far, you mostly end up with 76%. But if you're consuming more time, then you'll probably end up at the 61.8 area, which is roughly 29.32 on this cash basis. And I think that's probably where we're going. Down here, this is a 61.8 retracement, about 29.33.
Towards the election.
Yeah, yeah.
Because I've heard for some guys that don't think the Fed changes course until November.
Yeah, I don't think they can really, can they? I mean, they're all behind the curve. I mean, it's not as if these guys are really up on it. I mean, to be honest, I'm a big detractor of the central banks because, you know, they're brainwashed into sort of Excel spreadsheets and linear extrapolation, and they're far behind the curve. If they had a bit of foresight, they would have started to jack up interest rates in September last year after the northern hemisphere went on its, you know, came back from its summer holidays, because that's when CPI really started to take off. But they missed the signals. And also, if you look at you know, a lot of long-term cycles in interest rates, you know, you can see that actually the 35-year cycle, which, you know, topped out last in 1981, was bottoming this, you know, during the last decade. Right. Into the financial crisis. Then it stretched again because we had central bank intervention. So you had a sort of a synthetic support mechanism going in, and that sort of stretched the cycle out. But I mean, the more you stretch something like that, the more you're going to get a whiplash in the opposite direction afterwards. And that's why, you know, you've got this effect after COVID with CPI and inflation going berserk to the upside, because, you know, and it can't be, you know, I mean, anybody that's really a historian looking back at those sort of scenarios in the past has to realize that once you let the genie out the bottle, it's off and away. And that's what happened, you know, when Bretton Woods was disbanded in the 1971, and the whole gold standard was dismantled. So you let basically, you know, the gold standard drop away. You've created a sort of a fiat monetary system, and that sends inflation up. And the next minute, you know, you have central banks chasing the tail, and this is an exact replica of what we had in the 70s. I mean, you know, why these guys haven't already signaled that, you know, what's going on, I can't say for sure, but I think it's just like a bit of a drug, Peter, of cheap money, isn't it? I mean, everybody's drugged up Peter, with the.
Would you say that Europe's even been slower, even more behind the curve? All right, so tell me why, fundamentally, besides your wave structure, you're looking for a dollar crisis.
Well, I think the only way that the US can basically get itself off its cheap money scenario is by devaluing the dollar, because
so it's a policy option.
I think it's probably not a policy option. It's just, I think they're going to be forced into a corner at some point. Okay. And I think also, don't forget that this whole scenario with Ukraine and Russia is a bit of a sideshow, really, to what's going on behind the scenes. What's in the last few years, what's been going on behind the scenes is that, you know, China and Russia have been commoditizing their currencies in a big way through the central bank purchasing of gold, precious metals, well, mainly gold, and trying to basically break the US's dominance as a dollar reserve. Now, you know, it's inevitable that the dollar will not be able to hold on to its dollar reserve status to the same extent that it is. It won't be a crunch overnight. It's going to take several years, but, you know, you've got a way of reducing inflation through basically declining the value of the dollar. Plus, you've got this scenario where these other sort of Asian basket countries, led by China and the Eurasian banking system, is trying to wean itself away from dollars. That's why they're putting so much exertion and pressure on paying in local denomination currencies. I mean, the Russians are asking the Europeans to pay for their natural gas in rubles, and they said, "We'll cut you off if you don't." And so far, that seems to be working.
Yeah, so we kind of went through the Rubicon when we weaponized the banking and SWIFT system against Russia, so that if there was any trust left about feeling comfortable with your assets in that system not being frozen, that was kind of a signal that depending upon the administration, that your money isn't safe, your assets aren't safe.
No, and I think that, you know, if you're living in the US and you're domestic run, I mean, okay, you're going to be seeing the dollar will devalue, but you won't feel it. Only the only way you'll feel it is through inflation, which is what you're seeing now.
Right.
The only thing missing really is a major dollar decline. But, you know, talking about the dollar, I think that we're on the cusp of seeing a change in direction. Probably already have. When we saw this month the dollar start to decline from say 105, I think we've had 5 waves down from that peak, and we're going through a bit of a correction. I'm updating this chart tonight for our report. You can see that basis the CPI number you just had, but we've stretched up a bit higher. I had a target earlier this week at 103.28. We've pushed it up a little bit 1%. To the 61.8 extension level. We had 38% extension originally, being a bit conservative with that. But you know, if we can extend this like this by 61.8, yeah, that's probably done that rally already. I'll be selling dollars here, and seeing it to come down. But you know, overall, the problem we've got with the central banks is they're doing too little too late, and they're trying to catch up. A lot of the short end of the curve, like the 2-year treasury yields, they've already priced in most of the rate increases that the Fed can do this year. But a lot of the analysts in the investment banks at the moment are more concerned with the fact that we're facing a recession. Well, I mean, that technically means that you've got to have 2 GDP quarters, you know, in negative. I don't think we'll get that. We'll probably get 1. But so technically there won't be a recession. But I still believe that, you know, when we take a look at our forecast for the S&P, we're still going to see this next downswing develop. And of course, you know, at the beginning of the year, towards the end of last year, when Deutsche Bank did their survey of all the investment banks and what they expected the S&P, so over 70% expected the S&P to be 5% or higher this year, and 30% said it was going to be lower, and about 20% of those said it would only be 5 to 10% lower, and there was only 1% said it would be 20% lower. Well, we're down 20% already, so only 1% of the analysts in that poll actually had a forecast of 20% drop this year. Now, don't forget the Nasdaq's down 30% and the FANG's index is down 40%.
Yes.
Wow. I mean, that's incredible numbers. And I think we've still got more to go. Now,
yeah, it looks like this next wave, if we get it up there towards 44.5, is going to be much more directional than the first part of from the January high to 3,800. There were so many zigzags, and you know, I was trading it. It was very difficult to hold positions, except for that one rally back towards you know, 45, 50, 4,600 before the dump. That was pretty impulsive. But a lot of the other stuff it was hard. You just have to really just be bearish and not watch it for 2 months.
Yeah, well, I mean, we're pretty much when we're doing our type of analysis here, we're quite reliant on using fib price ratios, really, because generally speaking, our background thoughts are that most of the markets will deliver and unfold into specific fib price ratios, and most of the time they do. Sometimes they don't, and that gives a bit of open questions, and you've got to then sort of do some correlation ratios with maybe some related indices that have a different pattern, and choose one which is like a new benchmark or archetype at the time. I mean, when I remember this rally that you're referring to up here, I mean, that's a pretty good number, isn't it? When you get to 61.8 extension like that, and you go into reversal. So that was pretty well telegraphed during that time in late February, early March, that recovery.
And to get your scenario, Peter, we shouldn't take that high out, should we?
Which one? The secondary one?
Yeah, we should not take that high out on this recovery.
Well, this is classified as an X wave.
Yeah.
And X waves can take that high out if they wanted to. Yeah. Oh, because an X wave is a correction to the preceding zigzag, which starts from 48. So what it can't do is break 48. But it could break 46. I don't think it's going to do that anymore, because look, here we've got what I think is a 5-wave pattern up here. I think if you look at the Nasdaq, this where I'm pointing to right now, that was a slightly higher high than the one on the left. So I think we did get 5 waves up. That was also the case in the Russell 2000, the small cap index. So we've got a truncation here in the S&P. I think probably we're getting close to finishing this already with the CPI news coming out. And then we should get an extension ratio here. if we multiply that by 38 or 61.8, we're going to get into this little band of range here, and that should be, that should be enough to finish it really. So I don't think we'll go any higher than that, and then we can start sort of to plot the next decline. So, but overall, this is pretty neat stuff. I don't think there's going to be too much to worry about. The interesting thing that we had, of course, at the end of May, was that everybody was supremely bearish at the time. You probably have access to the CNN fear and greed indicator on their website, which was
it was profuse.
Very, very. And Bank of America Merrill Lynch, they sometimes post on the web some of their global fund manager survey results, and you could see that bearish extremes were very evident there. In fact, some cases, particularly in the NASDAQ, there was such a bearish extreme. They hadn't seen that since financial crisis. It was even more bearish than it was at the pandemic low. So we had a pretty good indication that there's going to be a counter trend rally. Since then, one or two surveys have come out from other sources, and they've said, that pundits have said that the rally that's currently unfolding to the upside is purely a counter trend rally, and yet they've said that there was an 80% advanced decline during this rally here. 80% of the equities were in advance rather than declining, and that normally is associated with a new bull market. So there's some pundits out there saying, "Hey, we're in a new bull market now." So there's a lot of conjecture going on. I think that as time wears on, I would have a fairly strong conviction that we'll get up to these sort of numbers, and then we're going to start dropping again. And by that time, this whole CPI thing might wear off a little bit, and we might revert to a little bit more bullish scenario going through the rest of this month into July, and then it's down to really basic economics, whether or not GDP is contracted by that time, and whether people start fearing that
they say they haven't priced in earnings downgrades yet.
So that takes time, doesn't it? I mean, that's a bit of a lagging sort of indicator. So what happens with the markets always, and it's very typical with interest rates at the moment, is that things lag. The data will lag. Certainly data does lag. I mean, it's like the ECB and the Federal Reserve and all the other central banks are really lagging far behind the price action. That's why we have to be very careful not to get carried away with expecting bonds to continue sort of declining rapidly, because a lot of the decline is already priced in, you see, and even though the central banks are hiking rates, there's a dislocation between what the forward months are doing and what the central bank's doing in the spot sort of situation.
Speaking of lagging, I've noticed that on this last rally before this decline in gold and silver, that the miners were lagging the move in gold. I own miners. Is there a different count in the miners compared to the gold and the silver?
Well, there is to some extent, because you're looking at bullion underlying as a commodity, and then of course if you look at the gold miners, it's an equity related entity really.
Because like Newmont's challenging the low it made when gold was 1780 that day, and Newmont's back to that low.
Yeah, well, I mean, the thing with Newmont Mining is that during the last several months, actually, it outperformed relative, say, to the GDX that you see on the screen here now. It pushed up and broke beyond these highs that go back to sort of August 20. Remember August 20 as a date? That was when gold sort of initially went up to 2070 back in August, and everybody got very excited that gold was going exponential, and then it sort of ended up in a two-year correction down. So but that was a very important date. Newmont Mining, let's have a look. I've got that here.
So you think GDX could make one more new low while gold holds 1780?
Yes, I don't think gold will go back below 1790 on spot. No, and here's Newmont Mining. You can see, look, it
so
broke.
You'd be buying it right here because it's right there, I think.
I prefer,
hasn't opened yet.
I prefer Agnico Eagle because that one hasn't really done so much. since moving up. So I'm actually looking at those which have been a little bit lagging. Let me just see if I can find it here.
Do you prefer silver miners over gold miners?
Well, I prefer silver over gold to outperform because of the gold-silver ratio. But when I went through some of the silver miners in order to sort of expecting them to be bottoming out as much, I couldn't find one that I really fancied buying at the moment. So I'm going to wait on that issue. I think it's right to buy the gold miners. I mean, I don't expect Agnico Eagle to break below 49.56 and certainly not below 45.41 because this, decline from the August high, the August 20 high, you've got a very eloquent zigzag down there. And you've got equality in the two swings, which, is atypical of measuring another form of measuring a zigzag. And you've also got a nice three-wave decline since 67. So I think that that's pretty safe if you're buying it on an unleveraged basis, which most people would do anyway. You're pretty in safe hands. This uptrend, will take off. And I think gold bullion, although, you've seen it sort of pop down in the CPI news, look at the way it's behaving in the last few minutes. It's running up again. And I'm a great believer that, silver and gold have bottomed already. And I think that Steve mentioned earlier that the bigger picture looks bullish on gold.
He said lower now, so that's what I mean. Even the gold bulls are capitulating now. That technically they think it looks bad with this action that they're seeing down here. I've been talking about 1810 as being a possibility, and 2210 in silver. I don't know what we got to here. What's the low that we have there so far?
Well, that after the CPI news on bullion spot, at least it got to 1825 here.
Okay.
And it's back up to 1842. So I'm, once
we're
done, I'm going to be
doing interviews.
And once we're done, I'm going to be buying this. As soon as
I know. So anyway, silver reverse too. Give me a report.
Yeah. I mean,
and euro reverse too.
Silver. Look, we've got down to here. I mean, these are really great levels. I mean, silver was perfect because look, back in May last month, we had a target of anywhere between 2064.53. We got to 44. We've had a nice reversal. The diagonal is crystal clear, really, this diagonal pattern, which is wave C of the expanding flat that goes back to the August 20 high. I mean, of course, there's nothing worse than actually seeing a perfect pattern, because if you start believing in it too much, you can always have that ability to be stopped out. But to be honest, I would assign a very high probability that silver bottomed at 2044. Should be buying on these dips, really. And I think looking at the gold-silver ratio, and I've got one here, which is quite phenomenal, really. This shows that when we got to the pandemic point in March 2020, this is just coming into view because it's actually taken the spot foreign exchange and working it all out. But it'll come alive as the data comes in. There it goes. But you can see it at the pandemic high at 126. That's 126 ounces of silver to buy 1 ounce of gold. Now, I since learned that during one of the Greek philosophers had mentioned in a text.
Steve Volgi.
Yeah, exactly.
Or Stelios Kantos.
Yes,
they're
exactly.
Philosophers.
Yeah. And the gold-silver ratio was what, 12-1, right?
Yeah.
And that was how it was historically. 126.
Steve remembers.
126. Yeah, he should. 126-1. Look, I mean, come on. And anyway, we've seen 5 waves down, a nice expanding flat pattern into 88. It's hit all the right numbers, the 23% extension of this. It's a 5-wave upswing. This upswing, by the way, the expanding flat began, hey presto, from August 20. So whilst we've had an expanding flat pattern in silver decline, you've had an expanding flat in the gold-silver ratio. So this widened out during the time, it hit 88.30. No, this is going down in a big way. So if you're really a gold bug and you're out there and you think, yeah, I want to get long of gold bullion.
You said that like Dennis Gartman says. He says
yeah, what does
long
he say?
of. He goes, I'm short of gold, I'm long of gold. And it's the first time I heard you use it, so it must be a European term. Long of gold. Go ahead.
Long of.
We don't use of.
What do you say?
Just long gold.
Oh, okay.
How are you of gold?
Oh, okay. Well, yeah,
All right, anyways,
we use the possession.
Look,
because,
I'm a crabby old man today.
No, it's good. No, it's good.
All
I
right,
mean, you also say horseback riding, don't you, in American?
Yeah.
I mean, where else are you going to ride a horse?
Yeah.
What do you need the word back for? Anyway, well, the Europeans have put of in front, so it's a sort of possession pronoun. So I think, anyway, right. I mean, there you go. But I mean, overall, if you want to be a gold bug and you want to buy gold, it's actually better to buy silver because of the gold-silver ratio. But we had a look at a platinum-gold ratio recently and a platinum-silver ratio, and it looks like platinum will outperform silver. And just this week, my colleagues and I, we've been discussing what palladium looks like, part of the palladium group metals, the PGMs, and we figured it out that palladium is going to outperform platinum.
Wow!
Into the inflation pot. So gold.
Russia, a major producer, is that the fundamental behind it?
Well, very likely. So gold's in fourth place behind silver, silver behind platinum, platinum behind palladium. So
wow.
You know, that's
catalytic converters.
Yeah, well, that's right. The European Union yesterday passed legislation that all combustion engine vehicles must be phased out by 2035. That's called a bit of a raucous.
Yeah.
So if you're buying a very expensive car at the moment with a combustion engine,
you're gonna have to scrap it.
It's going to be scrap in basically 13 years time. You know, you've got to, it's going to be illegal to drive. Okay, car's lifespan is probably about these days, isn't it? But
all right, how about just one quick look at the long end of the curve, maybe the bond market? Are we finally getting making new lows in bonds, new highs in the 30-year yield without the 10-year doing the same?
Well, we should be. There's a very distinct picture between the 10-year and the 30-year.
Yeah.
And the distinction only comes because if this is the 10-year yield we're looking at the moment from the pandemic low. The distinction really comes here around this point, which is I think April 20 and then this August 2020 low. Because this low, this one here, the second one is lower than that one, but in the 30-year it's not, which makes it different. This is describing a 5-wave diagonal, a leading diagonal. So the composition waves, the impulse waves, are composed of 5 price swings. For the 30-year, it's a bit different. You've actually got
a new high in yield today, probably.
Yeah, you've got, well, no, not quite.
It didn't do it, huh? On a strong number? That's interesting.
It didn't make a high. But here you've got a zigzag because look, you've got these two. This one is slightly higher. So basically, doesn't matter too much, but it's an interesting point to assess. This is a zigzag, A, B, 1, 2, 3, 4, 5 up. Actually, it's a diagonal. It looks more like this. So in actual fact, when you've got a diagonal, you're pretty much knocking on the door to a top. So we shouldn't be really making too much upside progress anymore. I think we've probably topped out already.
Well, you're the tops, Peter. How do people follow you and go to your website and sign up?
Yeah, thanks a lot. Yeah, I mean, if you're interested in subscribing to our stuff, we welcome the opportunity to greet new subscribers. Maybe I can just
go ahead.
Show you where to do. I think.
Yep.
This is our website, wavetrack.com, and down here somewhere, the subscriptions. And if you click on subscription, this is our most popular product for an individual investor. It's our Elliott Wave Compass report. it's $39 a month, and you'll get 2 reports a week, and you can download them using a PDF on our website. But you've also got an interactive login, and all of those latest charts for the reports are posted in there. So you get best of both worlds. And yeah, we'd be happy to see everybody if you want to subscribe. And I think you'll find it some pretty good value.
I concur. And Peter, I want to thank you for sharing all that hard work. I know you're like a mad scientist when you get lost in your charts. It's a I don't know, you astral project at the same time, and it's okay. And just goes to show that, you know, people do care about you because of the person you are and your great work. And so
Thanks,
really thank you very much for having a giving spirit for all these years, and just sharing your wave counts that take a long time to come up with for free with our community. Thank you, Peter.
Well, Dale, thanks. It's very humbling you should say that. And I know things are pretty tough out there for everybody trading. You know, I'm committed to making sure you get the very, very best. I won't settle for 1% less than 100. And yeah, and I appreciate you also giving me the opportunity to share my thoughts today and with everybody. And if you're listening in, thumbs up to Dale. You're doing a great job, and your immense knowledge, Dale. I really appreciate it. You always ask the right questions at the right time, and I really appreciate it. Okay,
well, you crystallize things for people, so you know we better get out of here. People, they'll post, get a room. That's what people do. So yeah, Peter and I have a bromance. He's my trading warrior brother. Thank you, Peter, very much. And everyone, you could join the team in 9 minutes for the Morning Edge, and hope you had a good week. We laid it out on the court for you. And remember, most of all, don't just count your pips, count your blessings. And thanks again, Peter.
Great, Dale. Thanks. Week. Thanks to you too.
All right.
And thanks to the whole team there at ForexAnalytix. Thanks, guys, for the opportunity today. And thanks to everybody for listening in.
All right. Adios, Peter.
Adios.
Adios, Face. See you guys. You're welcome.